different asset classes make more sense. So if you look at an investment approach, this is where you're going to be dealing with your stocks, ETFs, which stands for exchange traded funds. Very similar to a mutual fund, but mutual funds are so load heavy and so fee heavy that you're never going to make any money in a mutual fund. They're always going to underperform the markets. They're actually designed to underperform the markets. So if you have mutual funds, I can show you why they're literally the worst investment available. You have mutual funds. All right, let me show you why. So mutual funds will have, let's say they've got 10 investments. And they have more than this, but let's just use this as their 10, right? So let's say, and these are all stocks. Let's say that these 5 make money and these 5 lose money, right? In their prospectus, they would have said that each one of these was 10%, 10%, 10%, 10%, 10%, 10, divided out evenly, right? Well, what happens to the percentages on the winners? What happens to those percentages? They increase, right? So what they're forced to do is they're forced to sell their winning positions. What happens with these guys? They go down and buy their losing positions. Because they have to maintain a percentage. So they're actually allocated to underperform the market. So the way that I like to think of trading, or really where this applies as position to swing trading, is I'm always going to throw soldiers into a winning battle. Right? I'm going to scale into positions. So if the investment is making me money, I'll add more to it. Right? If it's losing me money, I'm going to get out. I'm not going to add. I'm not going to double down. Right? Because then, to me, when you start doing that, you're emotional. Right? Your game plan was wrong. Your ego gets in the way. You're not going to lose. Right? I'm going to dollar cost average down. And I've got some actual mathematical stuff to show you that would be, if you position scale in correctly, you make so much more money. And again, really what you're able to do is keep your investment amount small initially, and then as the position works in your favor, I'll give you an example. Let's say you bought the stock at $5, it goes up to 10, right? So you own it at 5, you buy it at 10 again. What's your average cost basis? 7.5. Goes up to 15. What's your average cost basis? 10. So I'm following up this position and I'm buying it as it goes in my favor. My cost basis is right here. I'm in a risk-free trade. This is how institutions trade. They'll start out, they'll go on a fee schedule or a schedule of buying and say, we're going to buy it here, and then we're going to let it go up, and then we're going to let it come back, and we're going to buy it again. And they'll do that all the time. And we'll talk more about that as we get into shorter term stuff where they refer to it as called defending a position. And we'll talk more specifically about that, of what they do. Because they'll have lots of capital specific values, and the stock can't go below that because then it goes to the negative side of the balance sheet. They will not let that happen. They'll keep throwing money at it until it stays right there. But this is a very easy way versus the opposite, right? It's at 15, it drops to 10, you buy it at 10, now your average cost basis is 12, it goes to 5, now your average cost basis is 10, you're still a loss 3 times greater than you were before. But again, what they tell you is, eventually it's going to come back. Even though most people are in this category. That's why you're fighting that. If you're a swing or position trader, you're going into programming that institutions have told you to think a certain way. This is not how they trade. It's not how they manage their money. This is where they are. And even here now, Goldman Sachs hasn't had a losing day in like 13 years. It's because all they do is this. They see your order coming in from California or Arizona, and they've got computers right next to New York that fill their order 0.4 of a second in front of yours. So they refer to it as electronic front running, but it's not currently legal. So they just see your order, they just hop in front of you, you buy it, it pushes it up. So, or they sell to you, either one. So you can see where this is kind of how the market teaches you or explains to you how to trade or how to do things that is wrong. Okay. So again, getting back to specific asset classes. So stay away from mutual funds if you want help. I mean, the only reason why he's in a particular mutual fund is that thing's been rocking. We still need
It's
to
a
get
five,
back.
it's an index 500 too,
Yeah,
S&P 500.
this thing is just on.
It's still up.
Yeah, so it's just like, if you're in it, if it's working for you, why get out at this point? But once it stops working for you, let's find some other stuff that'll work better. Position traders, you're gonna deal a lot with stocks, ETFs, but now you can start dabbling with options at this point. Okay, so now you can start adding another asset class. The longest term option you're gonna find is they call a leap. It's like 13 to 14 months out. So that's why you really can't invest. Sometimes they'll go a few years longer, but normally 13 to 14 months is the longest time frame. But you can position trade with options. Do you guys understand what an option is? A little bit? Okay. If you like stocks, options is typically the next step that people will take in kind of their sophistication. An option is the right to buy. But not an obligation. So if they've, typically they're 10% of the stock price. That's a typical range there. So if the stock's at 100, you're gonna be able to get the same control of that stock for $10. So you're basically just leveraging yourself. But you have the right to buy. So if the stock goes from 100 to 200, you have the right to buy it at 200. But if the stock goes to 50, all you lost was your initial investment. You didn't lose the difference. So that's where a lot of guys, when they first start getting into investing, they become a little more sophisticated, they'll look at the options world. The problem that you have with options is that I'm aware of, there are 247 different strategies. So people just fall into that pit and they never leave because there's so much to know here, right? Especially guys that are the engineers that like to use their brains and like to think and like to work through systems and methods and all that stuff. I mean, think about how long it would take them to learn 247 gizmos and gadgets. Decades. And guess what they'll never do? They'll never place a trade. Ever. Because they have to know everything about it before they'll ever do it, right? Analysis by paralysis. Paralysis by analysis. Very, very common for these guys. So they never actually ever place the trigger. And that's great for the world that I came from, the educational world. The best thing I wanted for you is I wanted to give you so much information that you felt like you knew everything, but you were too scared to push the button. Because if you lost money, whose fault would it have been? Mine. Heaven forbid it would have been your fault. I didn't educate you on something well enough, that's why you lost money. Clearly you did something wrong and it was my fault, not yours. So that's very common why most educational systems out there really just focus on options. It's a big, huge pit. You jump in, it's really hard for you to crawl your way back out and never actually do anything with it. But very common. Swing trading, you can get into stocks, ETFs, options. You can also start, in the swing trading, you can start getting into more of your currency classes. Maybe not necessarily trading of currencies on a weekly basis, but you can start focusing more globally with some of that stuff. As well as a lot of guys in this will also start looking at futures, but futures traders at this level, at a swing trade level, because again, they're thinking in terms of weeks, are guys that actually create corn. They may go buy a futures product against corn to hedge against their current season. That's very, very common for them. You and I are not going to hold a futures contract for weeks. It just isn't going to happen. Really, at this point, your best asset classes really do become currencies and Forex, or excuse me, the same thing. Futures, I mean. And then same thing down the line here. Getting real short term in stock trading, unless you're trading a very liquid stock and you have a ton of cash, becomes really hard. Okay. Now, what do you guys know about currencies and futures? Anything?
Not a whole lot.
Okay. Let's show you. Let's first start with the currency market. Currency market is 24 hours a day, 5 days a week. Started trading 6 o'clock our time today, which is in Asia and Europe, it's Monday morning. Not yet for European markets, but for Asian markets, it's Monday morning. So it's a 24-hour market, so those night owls, or people that like to get up at 2 o'clock in the morning, perfect for that. Trade the European Open. You have basically 3 separate markets. You have the yen, European, and US. That's kind of how the flow goes. This is at 6, 2, and then at 6 o'clock our time. So you can basically start in the European session and you can trade all the way from 6 to 2, 6 p.m. to 2 p.m. And back in the day when I first figured out how to do all this stuff, I did that. I was in front of the computer, I'm making dinner, trading the yen. My little boys were like, Dad, you making money on the candles? Because we're going to talk about candlesticks. And I just would be placing trades while I'm making spaghetti, you know. But that was my life. That's what I did for a long time. I don't enjoy currency trading as much. I prefer futures. There's a lot of manipulation in this market. I don't know if you're familiar with FXCM and some of these other guys. They actually had a dealing desk, so your order never actually went to the floor. They knew that 80% of traders lost money, so they would actually stop your trade right there and trade against you. They would take the other side. So you would lose, they would make. You're trading against the house. So my broker-dealer though, Fidelis, the guys that I use, no dealing desk. We have fixed connections right into the floor. We actually tap right into major liquidity providers, central banks, those guys. So we get right, we're not getting manipulated by anybody. So a couple other things, leverage here can be huge. You have different style of accounts. You can have a standard account. Very hard to find guys in the US that will actually take you though, because you're a US client, but there are still some. You have what they refer to as a mini account. You have what's considered a micro account. Now, standard account, you have to have $1,000 to open it. They'll give you up to 100-to-1 leverage. So you're extremely leveraged. Mini accounts, you need $100 to open. A micro account, you need $10. When I used to teach trading, the reason why I liked this product was because I could throw, a 10-year-old kid in an account with $10 and he'd only make a penny or lose a penny, but he could see the flow of the charts and had a little bit of skin in the game, if you call it that. But that was the way we like to do it. Most of the time, what people have, if you like currencies, is I'll just have them set up like a demo account. You can trade currencies on Thinkorswim. They'll let you do it. So that was some of the appeal of that. They've really gotten regulated. So the guy that I use that I do fund trading with now, with guys that I work with, he and I raised some money for him here in the United States when they no longer allowed U.S. clients. A lot of these broker dealers left the U.S. So now we're taking that firm and doing the same thing in New Zealand, so Australia. So that's currencies. Futures. Futures, believe it or not as well, is also a 5-day-a-week market. It shuts down for like 10 minutes just to kind of reset everything right at the U.S. close. You have the ability though, you can trade currencies with this. You can trade stock futures. They have what are called single stock futures. They have index futures. And they've got commodity futures. So you really have a wide variety of stuff. Like if there's a particular sector of the market or a particular S&P that you like, or Dow or NASDAQ, you can trade the future on that, and they're great products, they're great leverage products. So I like these guys the best. These guys have standard accounts. What is it to open $6,000?
3,000 is their minimum, but you need 5 or 6 to do future or to do gold and oil.
Gold and oil, yeah. I like commodity futures because how much they move. Just to give you an idea, and I'll pull it up here and just give you an idea of what it is. But I'd say, what is it? What does gold move daily? $3? About $3, $3 or $4 a day. Some days, it's dropped $200 in a day.
Yeah.
You make $10 a penny. So you can see if it moves $3 a day, you got plenty of opportunity to make a pretty good chunk of change just watching it. So But you gotta have rules, you gotta have systems in place, we're gonna get a little bit of that today. So this just gives you kind of a framework of futures, of how they work. Believe it or not, futures contracts are actually derivatives of options. So it's a derivative of a derivative. They're leveraged, but they're not as much as anything else. They're typically 20 to 1. So on a $6,000 trade, you're controlling $30,000 in the currency is typically or future is typically what you're controlling. Or, yeah, 2,000 is controlling 60,000. That's what it was, 30,000. I think that's what it was, 33,000 or something like that. So they're levered products as well. Here, where people lose money, if you understand currencies, where people lose money in currencies, is one, they're not educated. This animal is different than this animal in certain ways. 3 ways a market can move: up, down, and sideways. Within Forex, you get mean reversion systems as well, so there's just a different, added bonus. Currencies tend to be more like this. The dollar will fluctuate, but it'll fluctuate within a range for a while, like for a week, and then it may break out and stuff. So you get a lot of channeling, which makes it a little bit more predictable. Extremely liquid. This is $2.2 trillion a day exchanges hands. Governments, central banks, that's who moves this market. If they were to take all the independent traders of the whole world and we all clicked at the exact same currency pair, we would never influence the market. They would just absorb it. So, very, very liquid. The other reason why I like commodity futures is they're very, very liquid as well. Thousands of contracts every minute, all day long, are trading. So, we like liquidity.